Hey, what's up, everyone? This is Ryan from sellthatoption.com. And in today's quick little video lesson, what I'd like to do is I'd like to go over something called the MMM, or the market maker move. Okay, so here we are in our trade tab in ThinkOrSwim. And so what we're going to do is we're actually just going to take this down to 10 strikes per expiration period. And so what we're going to do is we will there we go. Okay, so what we're going to do is we're going to take a look at what each of these MMMs are. Okay, and so what this is right here is this is what the market thinks, or what the market makers are pricing into the current market, right? And so what we have here is this is the most recent expiration. So this is the expiration that's getting ready to come up. December the 7th, 2018, which is in 6 days. Today's a Saturday. And the market is pricing in 31% implied volatility and a $5.82 move. Okay. And so if we're looking to make a trade, let's say we wanted to do a straddle right here, and we were to go in and do a straddle, this is going to tell us how close we are to what the market makers are pricing their options at. Okay, and so right now we could get $5.61 worth of credit here in this particular trade, and that's going to be just under what the implied volatility or the market maker move is going to be. Okay, and so as we're creating positions, it's worth knowing what the market makers are pricing that move in at. Okay, so they're pricing in a $5.82 move, but we could get $5.61 of credit. And so it makes sense, right? It makes sense. And then let's go to December the 14th. We are never going to quite get the total amount of credit that the market is pricing into the move, right? And so let's see here. Let's go to December the 14th, and then we go in and we put in a straddle, and we're going to get $6.87 worth of credit here, but the market's pricing in a $7.17, right? In theory, this would be an arbitrage opportunity if we were to be able to get more credit than what the market is pricing into the option prices. And so we're always going to be just under the amount of credit, or the amount of credit we get is always going to be just under what the market maker move is going to be. And so when you're creating these trades, it's always decent to just take a look over here at the implied volatility percentile and what the market is pricing in the move. And so whenever I issue a trade, I'm telling you what the market maker move is, plus or minus $7.17. And so even though it's trading for 170 basically right now, in 2 weeks we can expect, right, based on the market maker move, that it's going to be a $7.17 move, or within a $7.17 move. Okay, and then the other thing to know about this is that almost always the actual moves themselves are less than what the market makers are pricing. Okay, and this makes sense on a number of different levels. Okay, if I buy an option, right, and we know that most options are either sold prior to expiration, some of them expire worthless, but we know that most of the time we're going to lose money if we buy options. Then we know that this is overstated. Okay, so this move is overstated. Okay, and so that's something else that's really important to know. So it's just a quick little video lesson thinking about where the MMM is and how we process through the MMM, and just thinking a little strategically about what that's going to look like. And you can also see the expected market maker move right here as well. Okay, and so you've got a number of different places in which you can see the expected market move based on what the market makers are pricing their options at. Okay, so I hope this makes sense. If you have any questions, please feel free to reach out to me at Ryan, RYAN, at sellthatoption. And otherwise, stay humble, stay hungry, and here's to our success.